Trump himself demanded rate cuts publicly, repeatedly. Markets expect him to cave, and Kevin Warsh walked into his first Federal Reserve press conference, held rates steady, dropped forward guidance entirely, and said, and I'm quoting him directly, "I've said for years, inflation is a choice."
Yeah, that's not what a puppet says, right, Craig?
It's absolutely not what a puppet says. And what he said next is what I think every South Florida homebuyer, every real estate agent, every person waiting for mortgage rates to come down needs to understand. Because there's a second part to this. A lever the Fed has been quietly pulling against the housing market for 4 years that almost nobody's talking about. And today we'll kind of break down both who this guy actually is and the hidden mechanism that could move your mortgage rate without the Fed cutting rates at all.
And welcome back to the South Florida Mortgage Report. Your hat dude wearing mortgage guy. I'm thinking more this one before, but Billy May, your hat dude wearing mortgage guy, always joined with Craig Garcia, president of Capital Partners Mortgage.
Hey, Bill.
We're back. Howdy. Happy belated Father's Day.
Thank you. Thank you. And same to you. It's a great weekend. And looking forward to get into this one. It was definitely.
Yeah. I know you've been watching this whole Fed transition closely, Craig. I know you really, you've been watching this for quite some time, and it piques your interest. So you're really looking forward to this deep dive.
Definitely interesting. So June 17th, last week, was Kevin Warsh's first FOMC meeting as Federal Reserve Chair. And it was one of the most consequential press conferences I've watched in quite a long time. Not because he did anything, but because of kind of what he said and how he said it and what he didn't say. So today's a big one. So we're going to do this in two parts. Part one, who Warsh actually is and what happened in that room. And then part two, the balance sheet, which is the hidden lever that connects directly to mortgage rates.
Yeah, so let's just dive right in. We got the new sheriff in town, right, Craig? So let's set this up for people that haven't really been following the Fed chair transition. Who is Kevin Warsh, and why is there so much anxiety about this transition, Craig?
Well, so let's see just some of the basics. He's a 56-year-old guy. He's a lawyer by training. He was on the Fed board from 2006 to 2011. So he was here through the financial crisis, and he's always been known as a hawk. So, meaning someone who takes inflation seriously and doesn't love the idea of Fed printing money and holding rates artificially low. But he was nominated by Donald Trump, and Trump's been very vocal about wanting to see lower interest rates. Now, immediately, he was basically beating Powell up at every opportunity, saying he doesn't know what he's doing. And so people were kind of worried that Warsh is going to walk in and suddenly start dropping rates.
Yeah. Yeah, and that's the concern. What's the Fed's independence, which is kind of sacred, how the institution work, and is that going to get compromised? And I'm wondering, like, how fast and how long is it going to take for Trump to call him stupid for not dropping rates or something?
Well, who knows? But yeah, Elizabeth Warren, during his confirmation hearings, basically asked him to his face, "You're going to be a Trump sock puppet." And he pushed back hard. He said, "I don't believe the operational independence of monetary policy is particularly threatened when elected officials state their views on interest rates." So Trump can say whatever he wants, but it doesn't mean that he's going to do it. So,
no, and the first meeting really reinforced that for sure.
I think so. 9 of the 15 Federal Open Market Committee members, 9, said they expect at least one rate hike this year. Not a cut, hike. So one person expected a cut.
Yeah, one, and and the rest of them said keep it neutral. So yeah, out of all of them, really got one that might want to cut, right?
And he comes out, he says the commitment to deliver price stability is strong, unanimous, and unambiguous, and it's an important message that we've missed for 5 years, and we're going to fix that.
Very, very strong statement, no doubt about it.
It's totally clear, and with his history of saying inflation is a choice, and that this is we will deliver price stability, hard stop.
Yeah,
so
no, for sure.
He's not putting himself in a position where he can suddenly do Trump's bidding on rates, saying stuff like that, and coming out this strongly in this press conference.
Oh, no, absolutely. And the press conference was interesting. I listened to all 42 minutes of it, but so walk us through it, Craig, and what was your interpretation of it?
So the first thing was the statement comes out, and I usually look at it, and they'll have the previous statement, and it'll have red lines with all the little nuances that were changed and what it says now. And this time it was just a big red strike through. So it was, they basically slashed the whole, it's usually 300 words plus. Now it's 130 words. So it's basically, they cut it more than in half, and it took out a bunch of the information that they're usually giving you there, which is the forward guidance.
Yes. What's your interpretation of that? Because there's a lot of stuff in there.
For the past, they said like 27 years, the Fed's been in the business of telling you what it plans to do next. They've said in the past, they said, hey, rates will stay low for a considerable period. We don't expect rates to raise rates until employment falls below 6.5%. So they've been broadcasting what they were going to do. And that's the forward guidance. And he basically walked in and said, hey, as a general proposition, forward guidance isn't the business that we should be in. So we're not going to do that anymore.
That's huge, really. And because we've talked about for, the year we've been on this podcast is that it's not what the Fed does, it's what the Fed says. And now he's saying, hey, we're not going to start saying stuff like that anymore. So it's a big difference from previous.
I had to kind of go through and do a little research on the forward guidance thing. And it was funny. Before like 1994, they wouldn't even come out and tell you what they did. They would just make changes and then the market would have to figure it out. And so then during the great financial crisis, that things started changing. And then during the process of getting through the great financial crisis, when they had already lowered rates all the way, they couldn't do anything else with short-term rates. And so since they couldn't lower rates anymore, they started coming out and using their meetings as a way to broadcast, hey, are we going to keep these things low for longer? And that was their way of doing something without having the ability to lower rates anymore. And so they could say, hey, we're going to keep them low for as long as it takes. And so that was kind of where forward guidance came, was born from. And then it's been in the system the whole time.
Yeah.
So it's a big departure from that.
For sure.
Yeah. And does it mean more volatility around the meetings? It certainly could. Yeah. Because
what does it mean for really markets? Like you're saying, the whole financial world has been trained this way for the past 27 years. And ironically, Alan Greenspan started this. He was a Fed chair from like 87 to 2006. He's the one who kind of started this in the late 90s, and he passed away, RIP, this morning, as a matter of fact. But that's kind of where all this stuff started. So what do you think what's gonna mean for markets now, the way that Warsh's statement came out the other day?
Well, so when they do take action, and there's more that we're going to talk about in terms of the communication, because he kind of said, hey, everything that we do is going to be under scrutiny and potentially is going to get changed. And so a lot of the communication that we're used to, they may stop doing. They may not do the dot plots anymore. The dot plots is where they had all these, everybody submits what they think rates look like in the future. So that's another way of them saying, hey, this is the forward guidance. This is what we're anticipating, and we're sharing it with the market. So if they stop doing more of that, then the meetings themselves could be more volatile. Certainly, we won't have as much of a heads up potentially as what's going to be happening. And they may do some more stuff that is surprising because everybody's just left to interpret what they think they're going to do.
Yeah.
And then he came out and said, basically said that wasn't like they're going to have a press conference every time either.
Yeah, I mean, he basically, he even mentioned press conferences specifically, right?
He did. He said, he used a quote from George Shultz, who was the Secretary of State under Reagan. He said, when you have one, you want to make sure you have something important to say, which, I think a lot of people interpret it as, if you don't have something important to say, we're maybe not going to have one.
Yeah,
we're not going to have one just to have one.
Yeah, don't say it. Right. Makes sense.
Yeah. So, he didn't, and we're talking about those dot plots. He didn't submit a dot plot himself.
Yeah.
He was the only one. And so,
that's right.
Yeah, but he did say, he's basically got a task force for everything. He's going to review everything.
That was interesting. It's funny. I kept I'm listening to it because actually I'm listening to it on a podcast. I wasn't watching it.
Yeah,
and it was a recurring, task force. He kept saying task force, and I'm like, boy, he's going to have a lot of these tasks. Well, he identified 5 key areas, but he's going to have a lot of these task force, and we're going to have the brightest minds looking at this and focusing on these task force. So I'm very curious to see how this happened moving forward.
For sure. But he did basically say all this stuff that we're doing on the communication front is open for discussion. So he already kind of told you what he thinks about the dot plot. He didn't submit one. He already basically removed forward guidance. So, and then he put press conferences on the table. So the idea that there's going to be a lot more vagueness and uncertainty about what they're doing, but he is saying, hey, we're planning on getting a lot of things done. So.
No, I thought it was great. And when he mentioned those 5 key things, and, he did say, we're going to look at data, how we're collecting that data, and we're changing the way we look at things now, which I found very interesting. Like, I'm like, okay, he's literally changing the way they do things. That's what's going to be interesting.
Well, this is it's his opportunity. New regime change comes in. He's the new sheriff in town, like you said, and gives you the opportunity to put some changes in place. Well, guess what? There's never been an opportunity for anybody that's coming in as the new Fed chair that has had the ability to use some of these new tools like AI
Yeah. Yeah.
to revamp the way that they do some of their reporting. There's been all kinds of scrutiny about the numbers that they are the big numbers that they use that the financial markets react to the most, the employment reports, which always are getting revised.
Yeah.
The CPI and what's included in the CPI number, all those things are probably up for a reevaluation of how they track that stuff. And then he also said, I thought was interesting, that it's the trend is more important than the number. So if they're using AI, they're revamping what they're looking at, they're looking at maybe the trend as opposed to just the number, and they have a better confidence of how they're looking at these things, then could they be able to be a little bit more surgically precise in how they do things?
Yeah.
Yeah, maybe that's, but the idea that they're doing all of that under this backdrop of, hey, inflation's a choice. We will deliver price, stability. That is, I think the market, it's funny, right after his press conference, the market sold off, rates got worse. The stock market sold off, rates got worse. People did not like the I'm not going to tell you anything
Uh-huh.
idea. The next
Right.
morning, they were kind of rebounding a little bit, and then obviously you have it's tough to split apart what people think about the Fed versus the changing dynamic with the war, because those are
Yeah.
the two big driver right now, short term. But I can tell you that I think that the bond market, generally speaking, they like the idea that the Fed chair is adamant about delivering price stability, because that means
Yeah.
he is not going to tolerate inflation if he does what he says, and that's what the bond market likes.
Yeah, that's the key thing here, I think, and like to kind of explain it to our referral partners, prospective home buyers, et cetera, like and kind of give us the elementary school ed section of it. And people say, "Oh, well, what do the Fed shares say? Is he holding rates? Is he raising rates? And are those the same things, Craig? Really, people always ask about that stuff, and we talk about that on here, but I think we should really kind of discuss that again.
So sure, I mean, just the big picture. The Fed controls the overnight lending rate that banks charge each other to borrow money for one night. That's really the only thing that they can do as far as interest rates go.
Right, right. If people think that, oh, the Fed's meeting and it's going to affect the mortgage rates directly, and we've talked about that. That's not the case. That's really not the case.
No, no, the Fed controls this overnight short-term rate. The market controls the long-term rate. And so
Right.
the only people that matter when it comes to mortgage rates that are the people who are buying long-term mortgage bonds as an investment. If
Uh-huh.
they're willing to accept lower rates for this 30-year investment, rates get better. If they want more, if they demand higher rates because of inflation,
Right.
then rates get worse. The Fed can't control them. They can try to influence the market. And so certainly what they do does influence the market. But this is this juxtaposition between this idea that Warsh could come in and lower short-term rates, and now suddenly mortgage rates are better, because that's exactly what might not happen.
No, no, you're absolutely right. I mean, the rates could go up. I mean, that's the whole point. And a lot of people think that I've heard people call me up. Well, I've had people say there's a new Fed chairman coming in. They're going to cut mortgage rates. We're going to get mortgage rates back into the fours and fives. I'm like, oh, that's not necessarily true. And this is the reason why. Like you said, it's basically up to the bond investors. And hey, do they want to hold on to that? That's the answer, really.
Yeah, if Warsh came out and said, you know what, rates have been way too high. The previous regime, didn't know what they were doing, and we're dropping short-term rates a full percentage point. I can tell you, people, there would be a lot of people that would be very, very, very disappointed to learn that that actually might make mortgage rates go up, because the long-term bond investors, they see that and they're going to say, well, we don't have an employment problem.
Right.
Inflation's already problematic. Now you're going to put more money into the system. That's inflationary. I can't accept a lower rate into the future. If my dollar is going to be worth less moving forward, I need to accept a higher rate. And
Yeah.
so, yeah, you could literally have the Fed lower rates aggressively and mortgage rates get worse, because the fear of inflation is tied to the lower. So it's a balancing act that they have to figure out.
Yeah. So, like you said, if the Fed were to cut rates tomorrow, it doesn't automatically lower rates. It can actually increase rates.
It definitely could happen.
Yeah.
And we've seen it happen. I
Yeah.
mean, there was, the Fed had cut rates, you know, a half a point in 24,
Yeah. Half a point. That was about, what, 2 years ago, I think, right?
and rates immediately got worse.
Yeah. They shot up. Like, remember, we went over like 7% for a brief period there.
And people were very disappointed, but that's the nature of the thing. It's the Fed can influence, but they cannot control. And
Yeah.
what they control is can have an impact on mortgage rates in a positive way, but it can
Yeah.
also be negative if it's
So the
considered
mortgage rate
inflation.
really is really a confidence vote on inflation, and that was his main target in his conference, was talking about inflation.
Absolutely. Unambiguous, unanimous, we will deliver price stability. That's the no. That was the key thing. And that's what the bond market liked.
All right, hey Craig, a minute ago you'd mentioned a trend, and Warsh said something about that, the trend mattering more than the exact number. So what do you mean by that?
Yeah, I mean, it seemed to be a pretty nuanced. I mean, he made the point that the 2% target is the left side of the decimal point, the big number for right now. The 0 to the right of it doesn't matter as much. What he's saying is, I'm not trying to hit 2.0 precisely. I'm trying to get inflation moving in the right direction. I need to see the trend is genuine. So, yeah, it's a different shift from Powell. He was really focused on the specific data prints, the monthly CPI number, PCE, and every decimal seemed to make a big deal about it. And Warsh is kind of saying, hey, listen, as long, if it's 2.9 or 2.3, I'm not going to worry about that. It's the direction and the pattern, not just this month's number.
Yeah, yeah, that's right. And one of the task force he talked about, because he used that phrase a lot, he said he set up a data task force for that, correct?
Yeah, that was one of 5 task forces, and one of those just re-examine all the data that it could use, like we were talking about. That too much of it is backward looking and it doesn't capture the real time efficiency gains that are happening in the economy. And yeah, with what AI is doing, productivity gains are happening faster than the government statisticians can measure. And he thinks that AI is a disinflationary force, comparable to, he's saying, to what the internet did in the 90s. He's drawing that parallel on purpose.
Yeah. So you mentioned that, like, I remember the '90s. You remember that. So what exactly happened in the '90s? Let's kind of revisit that topic for our listeners.
So the 90s was Greenspan era's greatest moment. Productivity exploded, the internet, computers, process improvements, the economy grew very strongly, unemployment was low. By every traditional economic model, there's a trade-off between unemployment and inflation. It should have meant rising inflation, but it didn't. Because the productivity gains meant companies could produce more without raising prices. So Greenspan trusted the new data where other economists were skeptical, and he held off raising rates aggressively, and he was largely vindicated. The economy ran hot, inflation stayed contained. We got one of the longest expansions in American history.
Yeah, yeah, and Warsh, he's thinking with AI right now, we have an opportunity right now to try to relive that moment and kind of deliver similar results economically, right?
He thinks we might be, if he's right. If AI is driving real productivity gains that suppress inflation in ways the old models don't capture, then the Fed may be able to achieve price stability and growth at the same time, which is what he said. You don't have to choose. He's making that bet. So it's the opposite of the old story where you have to slow the economy down to kill the inflation.
Yeah, yeah. So it's a segue to the part two we talked about. You said at the top there's like a lever that the Fed's been pulling against housing for 4 years that nobody talks about. So let's kind of get into that and see what it means for housing.
Sure. So right now, mortgage rates are right in the 6.5% range. 10-year Treasury is about 4.45, and this helps us kind of frame this a little bit. We said mortgage rates don't follow the Fed funds rate; it follows the 10-year Treasury yield, which is true. But that's really, it directly follows mortgage-backed securities yields, which they kind of move along with the 10-year. That's the closest numbers. So if you take those two numbers and you subtract, you know, 6.5 from about 4.55, it's about 200 basis points. So it's about 2%. The spread between, the gap between what the 10-year Treasury pays and what your mortgage rate is. So
Uh-huh.
historically, that's about 170 basis points, or about 1.7%. So right now we're running 30 basis points wider of a spread than normal.
Uh-huh.
The extra 30 years not coming from the 10-year, it's coming from the mortgage market specifically. and how the mortgage bond market is functioning right now.
Yeah. So what makes it wider? Why is that? Why is that the basis point structure go up and down?
Part of it's volatility. When there's uncertainty, bond investors demand a little bit more cushion, and partly the fact that the Fed's been withdrawing from the mortgage bond market for 4 years. The withdrawal is you've heard the term quantitative tightening, or QT, and that is something that they've been doing now for a while.
Yeah.
So
And that's kind of the starting point. So what about the balance sheet? He talked about the Fed's balance sheet. That's kind of in relation to what this quantitative tightening is about. So
yeah, so the Fed balance sheet, it's a list of everything the Fed owns, and the Fed owns a lot of stuff. About $6.7 trillion worth of bonds. Some are U.S. Treasuries. About 2.2 trillion of them are mortgage-backed securities, mortgage bonds backed by pools of home loans from people all over the country.
yeah, and how did the Fed end up holding $2.2 trillion in bonds?
They bought them deliberately, starting in 2008 after the financial crisis, and then in a massive way in 2020 during COVID. The Fed said, hey, the housing market needed support. Mortgage bond market was really stressed at the time. Private buyers were scared, and rates were spiking, and so they're going to step in, and they became a buyer. And then the fact that they became a steady buyer of mortgage-backed securities every month brought stability to market.
Yeah. And at the peak, right? The peak, they own like nearly 30% of the whole mortgage bond market, correct? The Fed.
Pretty wild. Yeah.
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 Wow.
So you've got, if you think about for the market, you think about you've got this buyer that's showing up every month, no matter what, it's buying tens of billions of dollars of mortgage bonds. Private investors know the Fed's there. The supply gets absorbed. The market stays liquid. Yields come down, which means mortgage rates come down.
Uh-huh.
At the peak, to May of 21, the 30-year was around 2.65 to 3%, and rates were near zero.
Right.
But the buying compressed that spread to its tightest level in years.
And then what happened in 2021, 22? What happened then?
The Fed, they had to act. Inflation happened. They had raised the Fed funds rate aggressively. They hiked 11 times in 18 months, one of the fastest tightening cycles in history, right as we were opening up this company.
Yeah, that's right.
And then they started quantitative tightening. So they let those mortgage bonds roll off. So when people were paying off their loans, when they're making mortgage payments, all that money coming in, they, instead of reinvesting that into more mortgage bonds, they just didn't do that, and so they just let the amount of their assets just slowly pay off.
Yeah, so explain that rolling off. It sounds like something that's quietly happened in the background, but it sounds like it really does matter a lot, correct?
So it's a lot bigger than people think. So the MBS, mortgage-backed securities, the bond, and every month homeowners across America make their mortgage payments, principal and interest. Those payments flow through to whoever owns the bond. When the Fed owns it, those payments flow to the Fed. So during quantitative easing, bond buying, the Fed took those payments and they've reinvested them, bought more mortgage-backed securities. So they're getting tons of money coming in every month from everybody making payments, and they were just using that to continue to buy.
Right.
And so that's so they reinvested basically their earnings. So they kept showing up as a buyer, kept the market supported, and then but during quantitative tightening, they just take the money in and they just stop, and the money kind of
Yeah, so it's
appears to
not
the
selling,
system.
just stopping the reinvestment, basically. So,
Yep, the pile of assets that the Fed owns just kind of shrinks, over
uh-huh,
time when they don't do that.
right.
Yeah.
And so that's the situation we've been in now for what, 4 years now, right?
So they have been doing that now for a while. Let's see here. Apparently this is worth something. So the Atlanta Fed, they kind of quantified this. Their estimate is that the full quantitative, tightening runoff was worth about 29 basis points of additional rate pressure in normal markets, and as much as 74 basis points in choppy markets. That's on top
Mm,
of the rate hikes. So housing got hit twice, once from higher rates, once from the Fed leaving the mortgage market. So
mm. Yeah, that's a situation we've been in, like you said, it's been going on for 4 years now. Interesting.
so 22, 23, 24 into 25, rates are up. Fed is exiting the mortgage market. The combination produced rates that, at their worst touched 8%, maybe briefly. And even if
Uh-huh.
Fed funds rate stabilized and started coming down, mortgage rates stayed a little sticky because the balance sheet was still working against housing.
But that cute quantitative tightening that ended last year, right?
So officially ended December 25. The Fed stopped the runoff. So that headwind is gone. And some of that relief is already kind of baked into today's, 6.5% rate without quantitative tightening. Ending would probably be higher than that, 6.7, 7% or higher. But it just kind of removed the negative. It didn't add a positive. And that's where Warsh and the balance sheet task force get a little interesting, potentially.
Yeah, that's one step. So what's the next step for Warsh and the committee and so forth?
So he's got, because he made this specific comment when somebody asked him about, do you think that the interest rate market is restrictive? And his answer was, well, if I look at a lot of the economy, it's hard for me to say that things are restrictive. And he said, like the stock market's doing great. Interest rates aren't causing a problem there. But he said, except for housing. And then he said, with housing, he said, that may be a function of the delivery method because we have two methods. One is interest rates and the other is the balance sheet. So if he was going to use the balance sheet, and what I heard from that was that's, that interest rates is not going to be able to help housing for the reasons that we kind of spoke about before, but the balance sheet may. And so what could he do with the balance sheet that it would actually help? So there's, I guess, three things that potentially they could do based on some research that we've been doing. So one is start mortgage-backed security purchases again, go back into the bond market as an active buyer. And the research seems to say, hey, listen, if they do re-enter, that mortgage-backed security yields are about 55 basis points lower if the Fed holds 24% of the available market versus holding nothing. Kansas City Fed research said that the COVID area buying program, about 40 points of spread compression. So active Fed buying, not rate changes, just the balance sheet, could compress the mortgage spread by 40 to 55 basis points.
That's a big. That's a big. If they implemented that, I mean, we go from kind of average 6.5 right now. We're getting back down to that 6% range.
You get down to 6% without the Fed doing anything in terms of lowering interest rates. So, and that would be meaningful. That's meaningful
Yeah,
just in and of itself.
absolutely.
And so, yeah.
And then there's a second tool, right? The second tool that we got to
So this is
talk about
interesting.
here.
Yeah. So this is interesting, and this is definitely outside of my wheelhouse. But it's called Operation Twist, and I guess they did this twice in history.
Uh-huh.
1961 under Kennedy, and they did it in 2011, 2012 under Bernanke. And the idea was you sell short-term treasuries, buy long-term treasuries. Balance sheet doesn't really grow, it just changes the shape of it. And why does that matter? Buying long-term treasuries pushes their price up, which pushes the long-term yields down. And the 10-year is the benchmark that mortgage rates follow.
Uh-huh.
So the 2011-12 version, Bernanke's maturity extension program, was about 667 billion over about 15 months, and the 10-year dropped somewhere in the range of 15 to 25 basis points. So if you did that today, 10-year goes from 4.45 to 4.2, 4.25. Normal mortgage spread on top of that puts the 30-year, potentially under 6. So
Yeah, so if they do those two things, I mean, we could be possibly under 6%. I mean, that's a totally different conversation that we're having with people now looking to buy a house, right?
it would be really interesting. I think, and I certainly more people are definitely actively engaging in looking into things. So,
Yeah.
yeah, no, I do. I definitely think it would be different. So the idea that without lowering rates at all, and really without really even talking about lowering rates, the idea that they could use some tools and get under 6%. Hey, we don't know if it's going to happen, but
Yeah.
it would be pretty interesting if that's what they have in mind.
So what's the outer limit if they went all in and did this, Craig? I mean, what do you think what could happen? What does that scenario look like?
I mean, if you just do this real simple math and you just add these different pieces together, they end they obviously they ended the runoff. They restarted buying, do a twist, and if inflation is declining, the research could suggest that we could experience 75 to 115 basis points of relief. That would put us in the 5.3 to 5.7%
Yeah.
30-year. But that's extreme, and
Yeah.
it assumes inflation's on a clear path down, which is not a guarantee.
No, there's a lot of dominoes have to fall within a nice order for all that stuff to happen, but boy, it would be nice.
Yes. And so the real key is what I've heard people say that one of the most important things about the Fed is that they their power is all about their credibility. And if people believe that they're in control and they know what they're doing, then that is worth so much. And if they don't believe in what the Fed is doing and they don't believe that they have control, that is really bad.
Yeah.
And so if none of these things that they're talking about doing will work if the bond market doesn't believe that inflation is under control. That's not a
Yeah.
small catch. I mean, it's the whole thing.
It kind of starts with that. I mean, that's,
Yeah, I mean, you're if you let's imagine you're an investor. Okay, you manage a pension fund and you're asked to buy 30-year mortgage bonds at 6%. If the Fed is simultaneously buying bonds, printing money in effect, and inflation is still running at 3.6%, what do you do?
yeah. Well, you want more yield, right?
You want more yield. Inflation's
Yeah.
eating your real return. If inflation's
Yeah.
3.6% and you're earning 6, your real return is 2.4%.
Right.
That's not going to feel like enough for a 30-year commitment. So you're going to want 6.5, 7%. The Fed's buying gets offset by private investors demanding higher yields. So the
Hmm.
policy would kind of cancel itself. And apparently it's happened in the 70s. I guess the Fed tried to suppress rates while inflation was running. And rates went to 18%. The market kind of overwhelmed what they were trying to do.
Yeah. So the sequence of all these events, it really matters.
Yeah, I mean, Warsh has got to establish inflation credibility first. He's got to get the trend moving convincingly toward 2%. He said it. He said, I got to be able to stand here and deliver some wins. So he was unambiguous about it. And he said, I got to deliver and we got to deliver. And yeah, we're going to look at changing a bunch of things. But he made no mistake about it. He said it was a choice. He said that it's in their control. They can do it. They can win on multiple fronts. And I got to come and deliver some wins.
Yeah. So whatever. The big question is, what if he can't deliver? That's the big question.
I mean, if inflation stays sticky or reaccelerates, the bond market loses faith, and mortgage rates they will definitely head back towards 7, and that will not be fun.
No, no. And that's where Trump starts calling him stupid or something. I don't know. That's what I think. So,
I,
but
yeah.
should be interesting. So, but so the clock is running. So bring it home, Craig. South Florida. If you're a buyer on the sidelines, what do you think this makes for the average home buyer or the realtor, our referral partners? So, what do you think is going to happen?
So number one, and we've said this for a long time. Don't wait for the Fed to announce a rate cut and expect the mortgage to move. Fed cuts the overnight rate. Bond decides, that it means inflation's coming back and mortgage rates go up. So if you're sitting around waiting for the Fed to cut rates, you could actually be that could be the worst timing. So so you want to watch inflation trends, not announcements, and watch the spread, not just the headline rate. Right now, the gap between the 10-year and the 30 years about 30 basis points wider than normal. If that just normalizes,
Uh huh.
and that's probably something we'll start talking about on this program. And even if the 10-year stands still, if the 10-year Treasury may not move at all, but if that spread comes down, mortgage rates actually improve anyway. So, and yeah, this part would be interesting. Watch when they're talking about the composition of the balance sheet,
Right.
and anybody on the committee starts talking about, changing what the Fed holds or owns,
Uh huh.
especially around mortgage-backed securities. That will be, and they might not even announce that. Yeah, I think that would be the thing that I think we'll try to keep our eye on too. Is the level of Fed buying, kind of, and it has to be transparent. May not be headline news, but I think but that's what'll give us some clues about what's happening. Are they?
Yeah, and we'll have more clarity by the end of the year for these 5 task forces he announced. The balance sheet will be reporting, and hopefully by the end of the year we'll have more answers from the research they've done.
Yep. Communications, balance sheet, data, productivity, and the inflation framework. So yeah. So the balance sheet one is the one that hopefully will be some implications for us in a positive way in the mortgage market. So
Yeah, Craig, this has been more and more educational conversations we've had on the podcast to try to, we don't just come on here and just talk about rates or whatever, but this is, we really wanted to kind of do a deep dive. And this is big news. I mean, this Fed, his meeting today is really big news. It can have a very big effect on housing over the next foreseeable future.
yeah, no, I thought it was very, very significant, all the different changes that he was talking about implementing, and he's taking on some big things, and he's trying to do things quickly. And we've seen, a lot of things get done lately with using some of these AI tools. And so hopefully, that change can be impactful and it can make the Fed more effective. And I'm certainly pulling for him because
Yeah,
we
I'm,
all
I'm,
have
I'm
we all have a stake in it.
absolutely. I'm looking forward to pulling up and watch this new show because there's a new sheriff in town. And his name is Kevin Warsh. So
Yeah.
it'll be interesting to see what happens over the next 6 months. So, well, good stuff, Craig. Thank you for joining us again this week on the South Florida Mortgage Report. And hope you got some very informative information out of this, and especially as the summer home buying system or season is kicking in. If you have any questions, feel free to reach out to myself or Craig, and we'd love to help you close more deals. And Craig, we will see you
At the closing table.
closing table. Howdy, partner.
All
Have a
right,
good
sir.
week.
Yippee-ki-yay.
Yippee-ki-yay. All right, sir.
Thank you for watching and listening to the South Florida Mortgage Report, brought to you by Capital Partners Mortgage Services.